So we'll continue from yesterday's session. Yesterday, just to quickly recap, we were trying to understand different types of what are the different types of financial statements, and we looked into the balance sheet statements, and we've taken a look at balance sheet of this particular company called ExxonMobil. So we'll continue from here on with the income statement. So some of this we have already discussed yesterday, but yeah, to quickly recap, so income statement, how is it different from a balance sheet? As Nitin was talking yesterday, it was balance sheet. Typically, you will look at it at a particular moment in time, at the end of the year, beginning of the year, or maybe any other time other than that. But income statement, on the contrary, it is looked at a particular interval of time, so maybe a particular quarter, a particular year, and likewise, and you try to see what happened to the company finances in that particular duration of time. So typically, income statement, the major elements of income statement are, so the revenue, how much of the money that you are making by your company operations, right? So that's the main important component. And after that are the expenses. It's basically how much is it costing for you to generate that revenue by making operating whatever the business operations that you're operating, how much it is costing you. So it will keep a track of all the different sorts of expenses, and at the end it will try to tally, hey, how much revenue are you making, how much expenses are you incurring, and it will at the end of the day it will try to give overall picture of net profitability. Is your company making a profit or not in the given duration, based on these two elements. So let's try to quickly go through some of these elements, what they are, and also at the end we'll try to look at some example and see what kind of inferences that we can make up from this data. So yeah, start with revenue. So mainly you can see depending upon the type of business or a company, the revenue items, like the main sources of revenue, will keep on changing. So here there is in general sense, if you have to look at all the companies, you can categorize revenue into two main buckets. One is the operating revenue and one is non-operating revenue. As the name conveys, operating revenue is basically the revenue that is coming from the core business operations of that particular organization or business. Non-operating revenue, on the other hand, it's the revenue that they have seen in that particular duration of time, but it's not from their core operations. Like, let's say we have given some good examples here, like interest earned on some cash that is available in the bank. So that is not directly from their operations, so it's considered as non-operating income. And rental income, it's basically, it depends. So if you take some other company whose actual main operations depends upon rental income, in that case this becomes operating revenue. So it all depends on the context of the business that you're looking at, and these items keep on changing, which items are in operating and which items are in non-operating revenue. And let me see. Okay, yeah. So
if I can just add a little bit here, Jagdish.
Yes.
So see, if you look at this, see what's the significance of the operating revenue versus non-operating revenue? Can anybody tell?
Something which is generated from the core business operations. Non-operating is something which is not related to their operations, but maybe they are selling assets or something, some other revenues.
Right. So for example, I think if we just take an example, right, then I think it will be really interesting for us to see. So one point is what you mentioned, Surya, which is, hey, so you may actually show profit in the income statement, right? But they actually sold a large asset. Okay. They sold a large asset, they made profit out of it. That profit, in fact, came into income statement, right? So net is the company profitable? Yes, company is profitable, but they sold an asset and got some profit out of it, right? So that goes into non-operating, sort of profit, revenue and profit, okay? Another thing that could happen is, for example, a company has like two different businesses. right? This happens many times, right? So it seems like, this company is working well, right? So there is revenue and there is profit and so on and so forth. But what's happening is, if you bifurcate those two businesses distinctly, right? So one would be a profit making, another one could be a loss making company, right? Then you are thinking, oh, if you actually think of it as, non-operating piece of it, and if you remove it, then probably this is not very profitable. So one sort of ironic thing that had happened before is the Bajaj group of companies very early on, when there was no competition and so on and so forth, right? They used to make very limited, so there used to be like caps on production and so on and so forth, and it was licensed and all that crap was there at the time. So there was a time when Bajaj used to take lots of advances from people, and that money was all kept in bank accounts, and that used to generate a lot of money for them, right? So there was no limit on how many advances you could take. So they had taken lots of advances, right? And so what used to happen was that so they used to earn a lot of money, not from production of these scooters, right, the Chetak scooters, but from the interest portion, right? So this is how you could look at how much of it is operating versus non-operating and so on and so forth, right? Okay, all right. So Jagdish, please proceed.
Yes. Yes. So, and typically, apart from that, there is one other small segment called other income. So, this is typically any other other than mainstream income sources that if there are there, typically they'll be considered in other income. So, moving on to the expenses. So, here within expenses, they go ahead and typically companies track each and every expense that is incurred. There are mainly two broad categories. One is called COGS, cost of goods sold. This is basically, as a company, if you are selling some products or services, what is it taking for you to generate or produce those goods and services, right? That's called basically cost of goods and goods sold. Apart from that, there is called SC&A, selling and administrative expenses. This typically includes, these are again contextual based on the type of business that you're working with. So typically in SC&A comes all other related expenses, like let's say wages, maybe interests and expenses that have been taken, or something like that. All of those things will be typically coming under this particular category.
Yeah. Yes, go ahead. Please go ahead.
Yeah, so there are certain terms called depreciation and amortization. So these are considered basically depreciation. You all understand. Basically, if you have a physical asset, you try to get its value over its duration of life by accounting for some amount of depreciation in each year. Amortization is the same concept, but it's applied for non-tangible assets. So almost the same thing, but it's applied for non-tangible assets. That's pretty much it. Chetan, you wanted to add something there?
Yes, yeah. I think research and development, you covered that also, Jagdish, and I will add a couple of points.
Yeah, so research and development is basically let's say if you see a company like HUL and all, right, they try to invest a lot of resources, like they have to have a good R&D team, all the technologies that are needed to invent new products and all of it, right? So all of that cost that is taken into that thing typically will be considered as R&D cost for them.
Yeah, okay. So see, these are some of the very interesting aspects of how things work and how to understand or how this framework, accounting framework and finance framework helps in understanding business. Okay, so let's take the cost of goods sold to start with. Okay, this is a very key concept. Associated concept is what is called gross margin. Okay, cost of goods sold means, let us say you went to a restaurant, right? So what do you want to have in a restaurant?
Ghee dosa.
Ghee dosa. Okay. Ghee dosa, nice. So if you want to have a ghee dosa, you want masala dosa or sada dosa?
Plain.
Plain one. Okay, all right. So you want a plain dosa, right? So now let's look at what costs them in that. Okay, so what's the typical cost the last time you have had?
85 to 100.
85 to 100 rupees. Let's round it off, okay? So you had, sorry, just 1 second. So you had, let's say 100 rupees, right? So that's the cost of one dosa, right? So have you ever purchased a batter, right? So batter, when we go out and buy batter, how much does batter cost?
40 rupees.
Huh? 40 rupees? Okay, I think you are not in touch with the realities,
The ID, not the ID one, the one on the small stores nearby.
Okay. Got it. Okay, understood. Recently I observed this, so at least anyway. So we will take, and either this or that doesn't really matter. So let's take the same example that you mentioned. It costs 40 rupees, right? So in 40 rupees, so we'll round it out to 50 rupees, okay? So 50 rupees, how many dosas can you make?
At least 10.
10 dosas you can make.
Yeah.
So per dosa, what is the batter cost?
5
rupees. That's it, right? So, so it costs only 5 rupees, right? So, and then what else do we have? You said ghee dosa, so ghee costs, huh? All right. So let's assume ghee costs maybe another 10 rupees, maybe, right? Okay, so let's assume 10 rupees of ghee, right?
Yeah.
And then yeah, there is the fuel also, right? So we have to sort of the fuel is burnt for every dosa, right? So let's assume that we have another, let's say maybe 5 rupees. That's reasonable, right? Or even I don't mind even calling it like 10 rupees. Okay, just fuel 10 rupees, right? So these are all costs, right? And that's the total of 25. So you have 75 rupees. Okay. So this is so if you look at it, so let's assume how much of the dosa pan do you need on a per dosa?
You're asking how many dosas can I make using one pan?
No, I asked you a very different question. The question that I asked you was, how much of the pan do you need per dosa? There's nothing like that, right? I think that's what you're saying.
Yeah.
So it is common. So the gas stove or whatever is the stove that they have used, and the pan, right? And in fact, the whole infrastructure that is required, you don't need it on a per dosa basis, but you need it en masse, right? So you don't make a hotel for one dosa, right? In fact, you make the hotel and then you churn out lots of dosas and lots of other stuff, correct? So what is happening here is that there is certain amount of material that goes into making the stuff that is being sold. In this particular case, dosa, right? So similarly, let's say you buy a phone, right? So in the phone, there is certain material that is going into it, including the labor that is going into it. In fact, we have not considered labor, right? So labor is the person who is actually making it and so on, right? So we can maybe add another maybe 5 to 10 rupees even there, because the person is paid probably a monthly salary, not a per this thing, but the component of that particular labor is going into the dosa, right? So otherwise, you cannot get it, right? So the person has to take it out, put it on the pan and, do the rounds and so on, right? And then that's when you get the dosa. So what's happening here is, so there is certain material that is going into the product that is being sold, okay? And the other aspect of it is that this is also variable, okay? Which means you sell one more unit, you have to incur that cost. Otherwise, you will not be able to sell it. So for example, will you get the phone without the material that is going into the phone? No, right? You still need the, whatever RAM, camera, right? The glass, the whatever chassis, all of that stuff is required for you to be able to make a new phone. Similarly here, there's certain component that's going in. So So this part, the one that you see at the bottom, right? That's 75 rupees, 65 rupees, whatever that is. This is called gross profit. And that's a very important concept of finance. Okay. So why is it a very important part? Because so you take, for example, let's take the same scenario, right? So dosa, how much, what's the gross margin that we have? Gross margin is nothing but, sorry, gross profit is nothing but 75 rupees is the gross profit. Okay. And this 100 rupees is the revenue. Okay. So gross margin is gross profit divided by the revenue. Okay. In this case, how much is the gross margin?
75%.
75%. Okay. So if you take, let's say, a restaurant business, right? We will take, let us say, we should ask this to Surya. Surya, what's an expensive hotel that serves dosas?
Not sure. Maybe for breakfast.
Not for, I mean, yeah, dosas anywhere. You could have dosa for a breakfast or lunch or dinner, whatever.
Chutneys.
Chutneys.
Yeah, chutneys.
That's a good one. That's a very good one.
Also.
Huh? Yeah,
Udupi.
Udupi is expensive. Come on, Surya.
There
A
is
person
hotel
by
nearby.
a person by your name has acted in that the Air Deccan movie.
Yeah.
And he takes you to Udupi only, right?
Yeah.
And Udupi is in fact an example of a very low cost restaurant, but good restaurant. Does I don't know if sorry. So Anushri, for example, do you know what Udupi means? Have you heard of Udupi?
Yeah, actually, one time I visited Bhopal, so there was a South Indian restaurant, Udupi. I had breakfast there.
Okay. How about Himanshi? Have you heard of Udupi? No?
No, Chaitanya.
No? Okay. All right. So Udupi, in fact, Udupi has a very long history. I don't want to get into that. It was the only king who did not side either with the Kauravas or the Pandavas. And what they did was they catered to both the parties. Okay, that was the Udupi king. And from then to now, they are still catering. Okay, and Udupi restaurants are by far, in fact, there was I don't know if Shravan notes near my house, there was an Udupi restaurant that was put up recently and it is full already, without, not even like 10 days have passed. Anyway, so if you look at this particular one, I think you were talking about chutneys, right? Okay, so let's take, others may not know what is a chutneys restaurant. So let's say Taj Hotel, right? You go to a Taj Hotel and, basically, I don't know how much dosa costs. Maybe Surya will know it or maybe someone else will know it. I'm not very sure. Let's say 300 rupees. Okay, probably it will be more. I'm not very sure. Let's call it 300 rupees, right? Their costs remain the same. Right? So all these costs that we have here, their costs are more or less same, right? They won't be very different. So for a 300 rupees dosa and you spend, let's say 30 rupees on it, right? So you get 90% gross margin. So that is the nature of this kind of businesses, the hotel kind of businesses, where setting up the whole infrastructure takes a lot more money, okay, than making that particular product. Okay, can you give other examples of this kind of businesses where the stuff that actually goes into what is being sold for an incremental unit, it takes very less, but to make it, it takes a lot of cost. Was my question clear?
Yes. Maybe FMCG companies, Chaitanya?
FMCG companies, I think that's a good question. So let us think of this, okay? So do you consider, let's say, Parle-G as an FMCG?
Yes, yeah.
Yes?
Yeah.
Okay, so in Parle-G, they sell for 5 rupees, they sell one packet, right? what's it called? Parle-G, it has the commonly sold one. The Parle-G biscuits only. Does it have any other name apart from Parle-G?
I don't think so.
Okay.
I think it,
So let's say 5 rupees, right? In that 5 rupees, how much does the biscuit itself cost?
small amount of batter, maybe 3 biscuits. So just estimating maybe less than 1 or 2 rupees.
2 rupees. Okay, got it. Okay, so 2 rupees, right? And also it involves transportation also. Huh?
Yeah.
And probably, we'll add 1 more rupee to that. So that is still about, let's say you get 2 more rupees. I'm assuming this, right? 2 more rupees and you get 40% margin, right? Which is 2 over 5.
Right.
So this is a product that does involve, does involve reasonable amount of margin, but it is not this kind of margin. Okay. So let me give you another example. Like for example, software. Right. So we buy software. Let's say we buy Tableau. Right. So the list price is like $800. Right. Per year. How much does it cost them to churn out 1 more new license? They already built the whole software, right? So to give 1 more license, it costs them not even $1 these days, right? They just send out an email. The server just runs a code and it sends out a code and it comes as an email to us, right? And that is hardly anything. So almost that entire 800 and odd dollars goes as margin, which means that the cost of goods sold, right, is as high as 99%, okay, or definitely above 90%.
You mean gross margin, right?
What did I mention? What did I say?
You mentioned COGS.
COGS. Okay, sorry, I meant the gross margin. So additional incremental cost is hardly anything. So their gross margin is as high as 95% plus. Okay, Jagdish, thanks for the correction. So any other businesses that come to your mind?
Education, coaching classes, adding 1 more student doesn't make any difference.
That's a very good point. Very good point. I'll come to that. I'll just come to that. Any other businesses? So Akhil, you were saying something?
Domino's or Pizza Hut, Chaitanya. So
Domino's
basically the large pizza 1,000 plus rupees, but it just cost us if we make it 100.
Got it. So that is another restaurant, right? Another restaurant. So let's think of other examples like this. So we discussed, sort of the software business. That's my favorite in terms of very high margin business.
Movie theater, Chaitanya. I think the seats, anyways, the expenditure would be same
Yes.
for electricity.
I agree with that. Yeah. So, so the infrastructure costs a lot more, right, than the an incremental person. So if the person comes in, they seat them, right? This is also what I think Sina was saying, right? These two have a very similar thing. Let me just so take another example of chip making, right? That's also very similar. I think there are 2 components that go into it. One is the software and the other one is the hardware, right? So to have that infrastructure, it costs a lot of money, but to make an incremental chip, right, it costs you very, very little. In fact, they literally put sand into it. Right? I don't want to trivialize that. We are actually facing a chip shortage at this point in this world. Okay, so let's take the other example. We just discussed about high gross margin businesses, right? Now let's talk about low gross margin businesses. Okay, so take for example, we spoke about let's take Cadbury chocolates. Okay, Cadbury Silk, right? So it costs roughly, so the big one, right? You remember the Cadbury Silk, the biggest looking one, right? So that costs roughly about, let's say, 150 rupees. Okay. Now so what I'm considering here is not Cadbury's, but I'm talking about the retailer who sells it, right? The retailer who sells that particular product. By the way, do all of you know Cadbury chocolates? Is there anyone here who doesn't know Cadbury chocolates? right? Everyone knows Cadbury chocolate. So for a retailer, I took this example some time ago. Does anybody know Palamuru chocolates? No, right? It doesn't exist, by the way. Right? So, so some unknown chocolate we do not know. Cadbury's has this brand image, and in fact, we may actually go and ask for and look for Cadbury chocolates. We may not even look for a chocolate. We may look for a Cadbury chocolate, right? So because of that, they command a lot of demand. So if you walk into a specific retail store, right, and you ask for a Cadbury chocolate and you buy it, it's 150 rupees. What is your guess about how much the retailer gets versus how much the company Cadbury's gets out of that?
Retailer might get very less.
Retailer may get very less. So how much approximately?
10%.
10%, right? Okay. So let's say 150 rupees, right? So in 150 rupees, let's assume, so because these products command a lot of demand, right? So retailers actually want to have them. So there is demand from retailers side also, because it will have the product moving and people may actually come for those products, so you have footfall coming in, so they may buy other stuff and so on and so forth. So for that reason, these companies demand a lot of premium. Okay. And so I would actually go with somewhere around maybe 7%, which is a reasonable thing, right? So how much is 7% of this? About 10 rupees. Yeah, roughly about 10 rupees, right? So let's look at just the retailer at this point. I'm not talking about the Cadbury's, the company. I'm talking about the retailer. So for the retailer, what is the gross margin? Gross margin is, in fact, it's the other way around. Actually, I think we should have done it.
10 up, 140.
Right? Yeah, so they end up getting, so 140 is the cost, right? And you have just 10 rupees that goes to the retailer, right? What's the margin here? That's the 7.5% that we were looking at, right? Look at that kind of business where, the software kind of business where the gross margin is upwards of 90%, right? And let's look at this kind of a retailer who gets very low amounts, right, as gross margin, right? So how does this affect what they do? Any thoughts?
So what it means, or how typically what they try to look for when the gross margin is less, is they try to play with volumes so that they can make this 10 into multiple of thousands or even more and get decent numbers.
Yeah, they have to sell a lot, right? So the way, anyone else would like to say anything? Okay, so the way it affects is, see, the nature of this business. Let us take the software business, okay? So you got to make a product that many people would want. That's number one. Number two is, so if you, initially, sort of, let's say you spent, let's say $10 million in making a specific software product. So up until some time, right, you are just getting very small amount of money, right? So when we buy, see, we are only paying $800, which is a big chunk of money, right? But we would not basically, sort of spend millions of dollars. We pay very small amounts. So that's one key aspect here. However, once people start buying, and let's say until you reach the $10 million, you in fact make no profit at all, overall profit, right? Even though your gross margin is high. But after you have crossed that break-even point, every time you sell, right, you are actually, most of it is the bottom line, which is the profit, net margin you more or less get. Okay. This is the nature of this kind of business, which is the software kind of business. But on the other hand, if you look at low margin business, right? Low margin business, so every time you sell, let's take a retail store, whichever is the retail store near you, right? So every time you sell one more Cadbury's chocolate, you're only getting 10 more rupees. This explains why many of the retailers, when you go to a Chotu store and you buy, let us say, a soft drink or a Cadbury's or something, they're not very excited to see you, right? Because they'll come, okay, you will pay them and they'll get, okay. So for them, you mean 5 rupees, 10 rupees, whatever that is, right? So do you see many retailer stores saying, oh, they are very excited to have you there? Right? They're not. And the part of the reason, and I'm not saying they're bad people or anything like that, part of the reason is that our change doesn't mean much to them. It is a very small, transaction and what we give them. Okay. So let's see. So that is the nature of this. So another point that I would like to make here is, if you take, again, the software kind of business, right? And a lot of the capability to earn additional whatever premium in the business, from the market, depends on the secret sauce, so to say, right? Take chips as an example, right? So they not only are very, intensive from a capital standpoint, but they are also intensive from an R&D standpoint. So it's something that Jagdish talked about some time ago, right? So R&D, so that kind of companies have the capability to invest more and more in research and development, right? But a company like, for example, a retail store, right? Even if, they have good chunk of network, they still have a limited amount of bandwidth to be able to invest into R&D, okay? That partly explains why a company like Amazon, which is a retail store at the end of the day, doesn't make much money from its sales, because it does keep investing into a lot of R&D, and technology in general. That's why their profits are very, very low, because it is a online retail, right? It is an e-commerce store. Okay, all right. So Sina made a point earlier. So let's talk about that a little bit. So you mentioned Sina. So I don't want to put you in the spotlight. Sorry, in a fix here. I was just so take the point that Surya also mentioned, right? Which is that you take let's say a theater, right? So you get additional person. You're not spending much on that particular individual, right? There is not much costs. Similarly, for a even this is true for edtech platforms and tuitions as well, that to get an additional person to serve a new student, it costs very less. But do you know that many of these companies are not profitable? Do you know why?
So like a lot of fixed cost for them, to get that class.
That is one reason. That is one reason. Yes.
Yeah, the contribution percentage is higher.
So
fixed cost.
So there is one fixed cost, but there is also another very important piece of it, which is the advertisement cost. Okay. What does it take to get a new customer in? Okay. Is very high, because the advertising cost is very high for them. Okay, that is what eats into the in fact, so it is so you could say so the advertisement cost in a way has become unitized at this point in time, because so you are now able to not just, let's say, if take Byju's for example, they have they have sponsored the Indian cricket team, right? So they would have paid hundreds of crores, right? Some of you would know. Yeah. Sina,
Yeah.
Some 700 crores or something. I don't remember how much it is, right? So one is that a lot of cost on that front, but there's also another aspect, which is that in order to get a new person in, they have to advertise a lot, right? And that has gotten unitized at this point in time. So it no longer goes into the SG&A cost, but it actually goes into cost of goods sold, because now you are able to identify how much it costs to get a new person in. Okay,
Yep.
so that is what sort of I wanted to sort of talk about. But this whole thing, so in fact, each of these, various costs, which is either cost of goods sold, selling costs, general and administrative costs, right? The depreciation and amortization, each of them have their unique imprint on a business, and it affects the dynamics of how that particular business behaves, what it can command, what it cannot command, right? So who the company is willing to value, who the company is unwilling to value, and so on and so forth, right? So it has a lot of these dynamics. I think it's a good idea for us to observe each of these things. Okay, so I think we are at 10:10 at this point in time. So Jagdish, anything else you wanted to cover?
Actually, we can, in a way, it's a long topic, so we can continue next time.
Okay, all right, sounds good.